A mortgage note, a residential mortgage note, the average lifespan of a residential mortgage in the US, statistically, it's 5 to 7 years. Even though that might be a 15-year loan or a 30-year loan, the likelihood is it will get paid off within 5 to 7 years. And so payoffs happen a lot. They're unexpected. There's a randomness to it. You can always sell the note on the secondary market. Let's say you've held it for a few years, collected payments, done well with it, but now you have a new opportunity you want to get into. So you could sell that note quickly if you discount it to the market rate. You can sell it really quickly. I find they're very liquid to sell. You can sell a note in a matter of a couple of weeks if you have a good network to market it to.
Welcome back, or welcome to the Conscious Investor Podcast. This is the show where we talk about health, mindset, and wealth. I'm your host, Julie Holly, and I'm so grateful you're here. Today, I am joined by Fred. There's a very specific reason I brought Fred on the show. In the course of the lifetime of this show, in over 500 episodes, Conscious Investor, we have never had a conversation about investing in notes. I paused to let that sink in for just a moment because a lot of you are like, notes? What the heck? We're not in middle school. We're not passing notes across the room. We're not going to get in trouble. Yeah, I know. When we hear notes, it triggers a lot of different things in our minds. And so today, we're going to actually dive into what are notes? How do we invest in notes? How do we utilize that in building out our investment portfolio strategically? That's why I'm so excited, because Fred is an expert on this and is seasoned and knows his way around the note space. Fred, I'm so grateful to have you today on the Conscious Investor Podcast.
Thank you, Julie. It's a pleasure to be here.
Well, we're really excited to dive into this, but I want to start with that question. And yes, Conscious Investor, there have been a few episodes recently where I realized I slipped and didn't ask the most important question of all. Fred, what do you do and how did you get started?
Yeah, thank you. I'll share a little bit with you about my journey. I started out in life having a very long and successful career working as a computer engineer in the tech industry. And it was during a real exciting time. I started my career right at the time of the beginning of the dot-com boom. And so if you can remember what that was like, it was a wild roller coaster ride. We had the birth of the internet, the dot-com boom, and then that was immediately followed by the bursting of the dot-com bubble. And we had the September 11th terrorist attacks. And so there was all this turmoil in the world. And the economy was all of a sudden in the toilet. And so what happened was I realized that I was working in a very cyclical environment. And I learned firsthand that I was taking on this huge risk. And you know why? Because I was relying on my paycheck as my only source of income. And so that inspired me to figure out how can I start to earn other sources of income, because I loved my work. I love my work as an engineer. And I also realized that no matter how good of an engineer I was, how valuable of an employee I was, if all of a sudden things were not going well in the economy or at the company, sometimes companies just go under, I could lose my job through no fault of my own. And so this is what inspired me to get involved in investing. And specifically, I wanted to learn about cash flow investing, where you invest in assets, you buy and build assets that generate income for you. And so this is how I stepped into the whole world of alternative investments. Started out with real estate, which is an amazing asset class. And after a number of years, I started to learn about mortgage note investing. And that became very interesting to me. I learned about the power of being able to buy mortgage notes at a discount. I also learned about the power of owning, holding those notes, earning a high rate of return from them. And the best part is that your investment is secured by an asset with tangible value. And so, no matter what happens, if there's a downturn, if the stock market takes a tumble, your capital is still protected from the downside, still protected, and most of the time it's still generating income for you consistently. And so when I learned about all of these different aspects of note investing, I became very interested. And over the years, it has grown. I left the engineering world, and this is what I do full time. This is my business. And I feel that it's a wonderful way to invest. And a lot of people just don't know about it. So I'm here to spread the word and share some of these ideas and concepts with all of you today.
I love all of this, Fred. I love mitigating risk. I love high returns. I love things being, backed by hard, tangible assets. And I I aspired way back when Super Rad Steve and I were, talking about our investment strategy. And one of my, when I'm, 80 years old, I just want to own notes. That's like the end game in a sense. It's almost like the holy grail of things because you're not dealing with property managers. You're not dealing with all the same infrastructure that we have to deal with right now. And so I'm like, oh, that's like what I want to do when I retire. Because I never want to retire, quote unquote. But I don't know much about notes. In fact, before we hit record, and I might offend, you know what? No, I'm not going to offend you, conscious investor. We all grew up in an era where we could say some of these words. So I'm going to just throw myself under the bus. And I think that I find it funny. I hope you find this funny also. But there's a point where you are ignorant, where you don't know anything about something, right? And ignorance is bliss. And so there was a point where I was ignorant about note investing. And then there was a point where I discovered, wow, there's this thing called note investing. And now I know enough about note investing to make me stupid. I'm not ignorant, but I know enough to make me stupid. Like I could make some really dumb choices because I don't know the finer details of it. So let's go back to the beginning and let's take some of our friends who have never heard of it before. It's ignorance,
Yeah.
not because of any lack of your own, because you just simply have never had exposure to it, conscious investor. So just know, like, wow, that was me 5 years ago. I had no exposure to this. And then I was exposed to it. I'm like, wow. So let's go back and let's just talk about we kind of have an idea about note investing, but how would we break that down for someone who's like, wait, Fred, what do you do? What is note investing? So let's start there.
Yeah. Okay. Sure. So lots of people know about investing in real estate and participate in investing in real estate, whether it's single family houses or commercial property, multifamily property, vacation rentals. But what if we talk about investing in the paper, investing in the debt, which are all the notes and mortgages associated with all of that real estate, all those properties. And so note investing is a real interesting part of the real estate business. And unfortunately, a lot of real estate investors, they don't pay any attention to it. For most people, when they think of a note and a mortgage, they think of it from the perspective of being the borrower and not as being the lender. But I'll tell you, when you get into note investing, it allows you to step across the aisle and become the bank. And so here we transition from being the one making the monthly payments to being the one receiving the monthly payments. And this really can stabilize your cash flow on an ongoing basis. This is what note investing is all about.
So wow, Fred, this is I hear you, conscious investor. Fred, I don't have $5,000 to loan somebody so I can carry a note on a house so that they can buy it as their investment property or as their whatever they want to use it for. So how do note investors get started?
Yeah, great question. Note investing, to get started, there's really two ways to get involved. You can get involved as an active investor where you go out and start building a portfolio. You're buying loans on the secondary market, aggregating them, building the portfolio. It's a lot of work, right? It takes a lot of time. Now, if you're someone that doesn't have a lot of time, maybe you are a busy professional, you're focused on your career, or you're a business owner, and you don't have a lot of time, you can do passive investing where you invest in a note fund. And what a note fund is where the fund managers raise capital from investors who are looking for a passive return. They pool all that capital together, go out into the secondary market. Now they're buying in bulk quantity. So what does that mean? Well, there's better access to notes. There is better negotiation for discounts. And for the investors, they get to leverage the experience, the expertise, the relationships, the access to notes that the fund managers have in return for receiving a passive income. And so that's really where to start, is to look at how much time do you have and how do you want to approach this. And it's a conversation I have every day when I speak with investors. Yeah.
Oh, I love this. Is this the same as right now? There are a lot of people that are opening up debt funds. So, would you consider this? How would you, when we hear debt fund versus note investing, is there a way that we differentiate the two?
There is. You have to look at what's the business model of the fund. A lot of those debt funds are doing loan origination,
Mhm.
which may be to investors, maybe originating hard money loans or business purpose loans. Also, it could be where we're buying existing loans on the secondary market at a discount. I mean, that's the area I focus in. So there's a lot of different business models out there. And so if you're looking at a passive investment, that's one of the things you want to look at and understand. And it's very important to make sure that the business model and characteristics are in alignment with your timing, with your risk tolerance, because all of that changes with each opportunity. So you want to consider that.
Okay, that's really helpful. So then what is I feel like this is one of those situations almost like Fight Club where you have to know the password. You have to know how to like what's the in, right? Like, oh my gosh, this secondary market for mortgage notes, it seems like a whole secret
Yeah.
club. Like, how do I get access to that? So
Yeah, absolutely. Well, you know something, Julie, I'm sure that just about all of you listeners out there can relate to this. You have you gone and bought a property or refinanced one, right? You go to closing, you sign all the loan documents, you did the loan application and all the qualification process. Then the grand finale, you sign that stack of paperwork at the closing table and you start making your monthly payments. You go home with the keys, start making those payments. And wouldn't you know, within 2 or 3 months, then you get that letter from the bank saying, Dear Mr. and Mrs. Homeowner, we're writing to advise you that your loan has been sold. Here is the name and address of the new lender, their contact information starting next month. Please send your payments to the new lender. And so there you are thinking, oh, did they not like me? Did I do something wrong? No, nothing of the sort. This is part of the model. And so the loan is sold, likely sold at a discount, so that the loan originator can recapitalize and then they're going to turn around the very next day and originate a new loan for someone else. And so on the secondary market, loans are bought and sold every single day. You can go up on Fannie Mae, Freddie Mac's website, look at their quarterly loan sales. They post it there as part of public disclosure. It's all there. And so this is what happens. Now, for us in the note investing industry, Yes, a lot of it is through relationship based activities. You have to know who the other investors are, build relationships with them over time. It takes a lot of work. It does. But there exists this huge secondary market for loans, whether you're buying loans, 5,000 loans at a time, or maybe you're an individual investor buying one or two loans for your Roth IRA to hold in there for long term income. There's a place for everyone there.
If someone wanted to come in, let's talk to two different types of investors. We'll talk to
Mhm.
the investor that's just loves to be curious and does have that self-directed account set up. And by the way, conscious investor, that I'm going to send you to directed IRA. I absolutely love working with them, and they have taken such good care of me and so many of our investors. So check out directed IRA if you are looking to self-direct funds. But with that, let's say an investor wants to use the conscious investor wants to use, some of their self-directed funds. How much should they anticipate? How much should they anticipate needing to allocate if they just want to buy one or two notes?
Well, it's a broad range. I mean, there are small balance loans, maybe $5,000 to $10,000 loan balance, going up into jumbo loan territory where we're talking 750,000 and up, million dollar. I mean, and everything in between. So there's no limit at all.
Okay.
It's a matter of what you're looking at, what you're finding. So you can buy very small notes, you can buy much larger notes. Personally, I like the idea of taking your capital and allocating it among multiple notes just for diversification purposes. I'd rather take $100,000 and buy four $25,000 notes so that it's diversified instead of buying one loan. But you know what? Sometimes it comes down to what you have access to, what's available at the time you're buying, and who you're buying from. So there's a lot of moving parts there to consider.
Definitely. And then what are the characteristics that we're looking that would distinguish a good note versus a bad note? If we're investing, especially if we're investing actively or passively, we want to be able to understand how to, differentiate and say this is definitely solid and worthwhile.
Yeah, this is a great question. Very important. I talk a lot about this in my book on note investing, handling the due diligence and analysis process. And so you're going to consider multiple things: the borrower credit, of course, the real estate market, the value of the collateral, as well as the track record and payment history on the note. And what's the risk profile? And so you're going to take all of those factors into account. It's good to make sure that, are you dealing with a solid borrower who has good credit history, good track record, stable employment? Or are you dealing with a borrower that has, let's say, they do seasonal work, and maybe you see a pattern in the payment history that every year around a certain time of the year, maybe it's dead of winter in a very cold place, their work slows down, they get behind a couple payments, and then once that season is over, things pick right back up and they get caught up again. And you see that as a recurring pattern. For some people, they may say, hey, that's way too much risk for me. I don't like that. And someone else may say, oh, I get it. I totally get it. It's seasonal work. I understand. And you're okay with that. And if you are okay with analyzing that risk, taking it into account, maybe you can negotiate a better discount for that note. And what's the result of that? You get a higher rate of return, because if as you take on more risk, it's going to increase your rate of return, just like any other investment. So those are really some of the basic characteristics. But in my book, I really cover a lot about how to do the analysis and perform that due diligence to make sure that you assess all the risks and you go into a purchase transaction understanding what it is you're getting yourself into.
So what's the recourse if, something goes south? the economy is shifting right now. Inflation is real. People are getting laid off, right? So what happens if you are the note holder, and the borrower is delinquent?
Yeah, this is a great question. So the beauty of this is that if the loan was set up properly, you are a secured lien holder on title. And so no matter what happens, your lien is in place, it's valid, and that property can never be sold or refinanced without that lien being addressed. And so you may have to wait, but you'll eventually get paid off at some point. And so you have all the rights and remedies that the lender has because you bought a legal contract. And so the standard loan documents always provide those provisions for the lender to what happens in the case of default, what's the process, and so on. And of course, there's variations state by state, and you would need to consult with your attorney about best way to proceed. But if there's ever a problem, what first line of defense is always your loan servicing company who manages your note. They're going to get involved, take action, do outreach with the borrower. And what I've found is that most times when there's a default or any kind of an issue, people need some flexibility to get the loan caught back up. Maybe they suffered temporary job loss or illness, something
Mhm.
happened. But all these things, people recover, right? People recover and then they get back on track again. And so the majority of the cases, just the diligence of a good loan servicer working on your behalf, they're able to handle the majority of those issues.
Nice. Okay, I should have asked this a while ago, but now that we're talking about the loan servicer, it actually reminded me we need to say who are the players involved. If
Yeah.
you are buying the note, who are the we have a loan servicer. So let's see who's on the field with us.
Yeah, absolutely. Loan servicing company is one of the most important partners that you would have as an investor. Think of a loan servicing company as the same way that a property manager manages your rental property on behalf of the property owner. The servicing company manages the note on behalf of the lender. And so they're going to handle collecting the monthly payments, sending out statements, preparing the tax forms at the end of the year that have to get sent out to the borrower and to the lender. They answer phone calls from the borrower if someone calls asking about checking on a payment or questions on the loan balance. They keep track of the amortization schedule, all the accounting on the note. The servicer handles that for you. And they do all of this for a very reasonable cost. Typically, it's going to be between $15 and $30 a month per note that's billed to the lender. But if you're managing a portfolio of loans, this is invaluable to
Mhm.
have this area taken care of for you. And certain states require it. They require that the lender has to utilize the services of a licensed loan servicer. But for me, I always recommend it, whether it's required or not. It's a good business practice to do because believe me, you don't want to be sitting there doing accounting on your own on a note and keeping track of amortization schedule and loan balance, sending out tax forms and all that. You don't want to be the one doing that. Loan servicers are set up to handle high volume. They charge a low cost for their services, and it's well worth it. So that's the main
Yeah.
main vendor to use. There's others as well, like your legal counsel. You want to have an attorney helping you in every state where the property is, right? We buy loans all over the US, and so we have relationships with attorneys all over the country. Also, your accountants, CPAs. Um, if you're involved with a fund, you're going to have uh, compliance work and SEC work, which is a specialized area of law. So yeah, there's definitely a lot of areas, but having those partnerships and relationships in place is what allows you to be successful in the business.
I know that when we are searching for property management companies, and we just went through, a selection process on a new development project in North Carolina. And so I very fresh in my mind. I mean, there are a lot of considerations when we're looking at property managers. What are the considerations when you're looking at a loan servicing company?
Yeah, this is a great question. Well, you want to make sure you're a good fit. Certain loan servicing companies work with and cater to smaller investors, and by smaller investors, I mean, let's say you have less than 500 loans.
It's like we're not an institutional investor.
Yeah, exactly. Maybe you just have one or two.
Mhm.
So you want to get to know who are the servicers in the marketplace, and do they handle the type of assets that you have. So these are conversations that you want to get involved with up front to make sure. And of course, there's fees and costs for different services, and how much do you want them to do for you, whether it's just the bare minimum or do you want like full service. And so you can pick and choose that as well. And so these are some of the considerations you want to have before you start. And the other thing is, talk to your fellow investors, get some references and referrals, saying, "Hey, who do you like? Who have you been working with? Do you have a good relationship with them?" It's like anything else in business. If you need something, ask a colleague for references and start with that.
Yeah, that's so true. What's interesting is that that's really very similar to when we're selecting a property management company for an apartment complex, right? We want to make sure, can you service a 200 unit apartment complex, or do you focus on, multifamily under 20 units? And what asset class? Do you focus on the class A, or you class C? Like, yeah, that's really interesting to see the correlation. And I know conscious investor, I mean, you've looked at enough real estate, multifamily syndications and such as a passive investor and asked these questions that I think you can see that correlation between the two. And so if you decide you want to invest passively in this, now you have, instead of having to build out a new knowledge base, you have an underlying understanding of the concept, which is really
Yeah.
helpful.
Yeah, I couldn't agree more.
That's so helpful. On the active side, if somebody wanted to, again, they want to go play, are they just going to Google, secondary mortgage notes for sale? I mean, is there going back to it feels like a secret, I got to know the right kind of knock or the passcode to get in, like how do you even find where these are for sale?
Yeah, that this is true. This market, everything is through personal relationships.
Okay.
And so you have to get to meet people. You have to go to events, industry conferences and events where you're going to meet other node investors. A lot of things happen through personal relationships. There's not a public um, marketplace per se. And there's also a lot of effort goes into qualifying to be able to buy notes, to bid on notes, because note sellers, if they don't know who you are, they're going to want to make sure you are going to be able to close and complete a transaction, or are you just a tire kicker wasting time? A lot of them will ask for references for you as a buyer, saying, "Hey, we want to talk to other people you've done business with in the past." Um, and so it's very important to get good at building relationships, and you have to put the work into it. It really is a lot. It's a big part of what I do, is building and nurturing relationships.
This is really fascinating because I think that we're so accustomed to, if we want to invest in stocks, most people will go to a financial planner and say, "Here, figure out some stocks for me to invest in," right? If people want to
Yeah.
invest in real estate, generally people will go to a broker of some sort and say, broker, I would like to buy, a quad or a triplex or a small multi, right? And so they'll go to a very clearly defined professional to gain access to that type of information. So it sounds like this is a little Wild West like, where I'm a huge Star Wars fan. So this just reminds me of going back to, some of the Star Wars bartering type things, although this is all legal and it's not bartering. And maybe I shouldn't try to make that reference, but it just has that underpinning of who do you know so that you can gain access to even transact in this way. And that's really fascinating.
Yeah, it's very true. And for some people getting started, it can be frustrating. I know. It can be frustrating. They want to get involved. They're having trouble finding notes to buy. In this particular marketplace right now, there's a lot more demand than supply right now. That's a function of the real estate market, by the way. So it is difficult. And I always tell people, if you want to get started, a great way to start is be a passive investor. Be a passive investor in a note fund. It's a great way to start building relationships, get to know people, and get some experience that way. And so you can be a part of note investing while you're sitting in the passenger seat working alongside professionals. And it's a great way to start, especially for someone that might feel at a loss or feel frustrated because they're not able to get traction to get started.
So good. All right. We want to hear final as we wrap up. Now we want to know, show me the money. What are the returns like?
Well, returns are going to come down to this. It's how much risk are you comfortable with? And so I'll give you some ranges. Let's say you want to buy a super safe note with a ton of equity backing the debt, and it's a pristine trophy property. The rate of return on that might be 5-6%, right? Okay, and what if you're willing to take on a little more risk? What if we look at less desirable properties? Or what if we look at a less than perfect payment history? Or a borrower that is considered high risk? Could be a second or third position lien. It could be a business loan. Now we start getting into higher rates of return, 8, 9, 10, 11, 12%. Those of you real estate investors familiar with hard money loans, you can buy those. Those are paying 12, 11, 12 and higher percent. The only problem is they're short-term loans, so those are going to pay off in 12 to 18 months usually. And then your job is to go back out and redeploy that capital. But it can be very lucrative. If you're comfortable in that space, that's an area you can get into. And so the rate of return, it's all across the board, and it comes down to how much risk are you comfortable with. But it's like anything else. When you get started with something new, it's always good to go with a lower risk, lower return, get comfortable, and then over time, you can grow and expand and venture out into other areas and increase your rates of return as your knowledge and skills increase. It's the normal evolution of an investor in any asset class.
Yeah, that makes sense. I know that was supposed to be my last question, but I have failed to ask a really important question, which is exit strategy. Do we have multiple exit strategies, or are we waiting until the person? What better question? Hey, Fred, what are the exit strategies when we invest in notes?
Yeah, exit strategies. There are many for sure. First of all, a mortgage note, residential mortgage note, the average lifespan of a residential mortgage in the US, statistically, it's 5 to 7 years, even though that might be a 15-year loan or a 30-year loan. The likelihood is it will get paid off within 5 to 7 years. And so payoffs happen a lot. They're unexpected. There's a randomness to it. It's a good thing when it happens. If you bought the loan at a discount, now you're getting paid off in full. So you get a high rate of return there. So that's one exit strategy that's happening whether you like it or not on an ongoing basis, because borrowers always have the right to pay off a loan,
Mhm.
right? Of course. So other than that, you can always sell the note on the
Okay.
secondary market. Let's say you've held it for a few years, collected payments, done well with it, but now you have a new opportunity you want to get into. So you could sell that note quickly if you discount it to the market rate. You can sell it really quickly. I find they're very liquid to sell. You can sell a note in a matter of a couple of weeks if you have a good network to market it to. It can happen a lot quicker than trying to sell a piece of real estate. That's for sure. So that's one exit strategy: sell the note. Another one is you can borrow against it. You can leverage the note, which is called hypothecation, and more a little bit more of an advanced topic, but you can leverage that, borrow against it, and recapitalize that way as well. So you do have a few different options in your toolbox at your disposal.
That's really fascinating. Have we the whole point, the part about selling notes, the second strategy, it sounds like, hey, that seasons the note you have is seasoned a bit, so there's proof of
Yeah,
concept. It makes it easier to sell. But going back to the average lifespan, are you guys starting to notice a shift in how long people are holding note, or staying from that 5 to 7 years, just because interest rates were so low? I know I have like a 2 point something interest rate on my current personal residence. And I'm like, I think I just want to like hang on to this thing because it's a
yeah.
great
It's going to take a lot to give that up, right?
right. So is there a shift? Is there a ripple happening in the note space right now?
Yeah, for sure. There has been during the low interest rate times, we were seeing tons of payoffs,
Oh,
tons.
people refinancing into the
Um,
lower rates.
Yeah, people
Um,
refinancing to get a lower rate totally makes sense. So now that has leveled off for sure. And now there's much less. It's cyclical, it is. But still, even though rates are higher now, every day people are moving, they're downsizing, they need a bigger house, they're moving to a better school district, they need more room. So they're selling a property and buying another one.
yeah,
And so it's still happening.
yeah.
Yeah, and it always will be.
Yeah. Wow. Fred, this has been so insightful. And Conscious Investor, I think you're just as excited as I am to learn about another alternative investment strategy, and that you can, yeah, you could go and you could build the relationships and you could do the heavy lifting and take your time doing that. Or you could, develop some networks, reach out to Fred, learn about investing passively in notes and diversifying your portfolio in another facet, which is really important. Just remember, you want to make sure that you understand what you are investing in. And so one way you can do that is by picking up a copy of Fred's book, read through it, make sure you understand the asset class. Don't just walk into something blindly, because you need to be able to understand the vernacular, and what is taking place and what you can expect, and so that you can make a wise investment moving forward. Fred, I'm grateful for your time and your willingness to just pour into the conscious investor. What is the best way for them to connect up with you?
Yeah, thank you, Julie. Appreciate that. Best way to reach me and connect with me is by visiting my website, which is fredmoskowitz.com. And if you prefer a little bit of an easier spelling, you can go to giftfromfred.com. And that'll take you right there. Once you're at my website, you can connect with me, send a message. I have a special report I'd be happy to email out to anyone that would like to request it, talking a little bit more in depth about note investing. I always love hearing from investors, connecting with investors, and building relationships because it's a big part of what we do. And feel free to check out my book, The Little Green Book of Note Investing. It's available on Amazon.
Awesome. Thank you so much, Fred. Conscious Investor, thanks so much for taking time to dive into this topic with Fred and I today. Remember, You have no idea how invaluable it is when you take that moment to rate or review in an honest way any of these episodes. It gives us insight, and honestly, it just adds rocket fuel into the podcast and into the movement. And so take a moment to leave an honest rating and review. I love hearing from you. And remember, Conscious Investor Growth Summit 2025 is coming up, and you don't want to miss out. We're going to be talking about all things health, mindset, wealth. Space is limited to 150 attendees only. And I believe in meaningful connection, not in mass quantities and lots of people just, flipping cards in the hallway. This is a place where people form real, meaningful connections and friendships. It is an experience. It's not just about being tucked away in a seminar all day and being spoken to and spoken at. We have practical, tangible information. Every speaker is going to give you something that you can walk away with, that you can apply, boom, tomorrow, today, right? Plus, we have the cold plunge. You don't want to miss it. And even if you don't want to go in the freezing cold Lake Coeur d'Alene, you can always cheer everybody on from the shore. But it's a great experience that you don't want to miss. Lots of other fun activities and excursions taking place. Head on over to consciousinvestorgrowthsummit.com to secure your ticket. Do so before they are gone. You don't want to miss out. Until next time, cheers to your health, your mindset, and your wealth.